Good morning, good evening, wherever you may be, across the nation or around the world. My name is Shane Squarick, and on behalf of the CMT Association, I am pleased to welcome you back to another webcast as part of the CMT Association's educational web series. Today, on October 25th, 2017, we are joined by Steve Nison, CMT, as he presents Common Candle Mistakes. Mr. Nison is an expert on Western technical analysis with over 30 years of real-world experience. He has authored 3 acclaimed books, including Japanese Candlestick Charting Technique. Regarded as one of the most foremost technical analysts in the world, Mr. Nison's client list includes Fidelity, JP Morgan, Goldman Sachs, Morgan Stanley, NYSE, and NASDAQ market makers, hedge funds, and money managers. His work has been highlighted in the Wall Street Journal, Worth Magazine, Institutional Investor, and Barron's. Steve has appeared numerous times on CNBC, and his segment on FNN brought in the most viewers that the network ever had. He's sold out seminars and has been hailed as the most valuable and entertaining in the industry. Steve has presented his trading strategies in 20 different countries to traders from almost every investment firm on how to apply and profit from these methods. Steve has also lectured at numerous universities, including Baruch and Cornell, and he was a guest speaker at the World Bank and Federal Reserve. He was among the first to receive the Chartered Market Technician designation and was previously a senior technical analyst at Merrill Lynch and senior vice president at Daiwa Securities. Currently holds an MBA in finance and investments. As always, we welcome you to submit your questions throughout the duration of the presentation using the chat box to the left of your screen. In the interest of time, however, we may not be able to get to all of your questions until the end of the formal presentation. Your participation in today's live webcast does qualify you for 2 continuing education credits, which will be automatically added to your account if you registered online through the shopping cart. With that said, and without any further ado, I am pleased to turn the floor over to Mr. Steve Nison.
Great, thank you so much. Sean had mentioned that I'm an expert in Western technicals with over 30 years experience. It is true with the Western technicals. I'm an expert. I've actually been doing them since 1974, but for 30 years I've been using Japanese candlestick charts. In fact, I revealed them in 1989. Amazing how quickly time has gone. And what we're going to be doing, and before I start, by the way, I will be taking questions throughout the session. If we're running short on time, I'll say let's hold off on questions until the end of the session, but feel free to text questions as he had mentioned in the chat window. So what we're going to be doing in this webcast, which will be a video, is kind of examine candlesticks, kind of give you an inside view of the more common candlesticks mistakes. There's a lot of information out there. Unfortunately, a lot of it is incorrect. I'm really thrilled to know that before my book came out and before my work, there was not one charting system anywhere in America or Europe or anywhere in the Western world that had a candlestick chart. And now the default chart is a candlestick chart. In fact, the paper I wrote for my CMT was on Japanese candlestick charts because nobody knew about them here in the Western world. So that was my paper. And back then it was great. It was only 2 parts to the exam. It was multiple choice and a paper. So speaking of exam and giving an inside view, I recently had to go to a doctor, and because I had a little bit of a headache, and I wanted him to check me out to give me an exam, and luckily he didn't find anything. And when I mean he didn't find anything, literally he didn't find anything. So we're going to be kind of looking inside some of the strategies with candlesticks. The assumption is that you already are familiar with candlesticks. I'm not going to go over the basics, but just to remind you, the major advantage of candlesticks is they give you twice the information as a bar chart, because candles, like a bar chart, will show you the price. But the real potency of the candles is they show you the force of the move. And especially for those who trade Forex, because there's no volume in Forex, this is a great way to gauge market strength. In the non-Forex markets, we have the advantage of looking at volume to have another gauge of more, kind of the force behind the move. But candles give you that extra x-ray into the supply-demand situation. So for example, here we have a green and red candle. Depending on your charting system, it could be black or white. And the green candle or white candle obviously means, I shouldn't say obviously because, normally when I talk about the candles, you may see a white and black real body, but instead of white, we're making it a green. So the green real body means the opening is down here. The arrow pointing. Okay, the opening is at the bottom of the green real body, and the close is the top of the real body. Just refreshing memory, there's the real body, and the lines above and below are called the shadows. Some people call them whiskers. So this obviously is showing on this session the bulls are in control. A long red real body where the opening is at the top of the red real body and the close of the bottom. The bears are in control. So who's in control here on the right with this doji? Is it the bulls? Is it the bears? Or is it neither? And the answer is the market's at a point of indecision. A doji during a market rally, the Japanese will say the market is tired. And I don't have time to get into all the nuances here, but keep in mind, just because there's a doji in a rally doesn't mean the market's going to go from up to down. The doji turns the trend from up to neutral. And there are lots of things you could do with the doji. You could use the doji as resistance and so forth. But just to kind of refresh your memory with this slide is that we use the candles to see who's in control of the market at the time the candle line is formed, whether it's an intraday, a daily, a weekly, or even a monthly chart. Now, there's a nice Japanese proverb that says it takes the clap of two hands to make a sound. And the reason I wanted to bring out this particular proverb is because our eye normally goes to the real body. It's a thick part of the candlestick line. But we also always have to remember to use shadows. This is a very common mistake. Shadows are, not the first thing visually we kind of focus on, but shadows really give you important insights and also into the supply-demand situation. Now, we're familiar with a lot of candlestick lines with a single upper shadow, a lower shadow. For example, a hammer has a long lower shadow. A shooting star has a long upper shadow, twice the height of the real body, and so forth. But you could also pay attention to shadows when you have a series of shadows converging at the same support or resistance areas. Let me show you a point here. So notice here we have a series of long upper shadows. Some of you may recognize, a candlestick signal over here, shooting star. Classic shooting star. By the way, it's important, and we'll look at this a little bit later on, to view candles in the context of Western indicators. So the shooting star becomes particularly potent because it's confirming a resistance area. Right? But even if this wasn't a shooting star, okay, say the real body was bigger, we would have a plethora of long upper shadows right around the 83.5, 84 area. And what is that upper shadow showing us? That at some time during the session, the market had rallied, but by the end of the session, what happened? Although these were white real bodies, by the end of the session, the market had pulled off the highs. So this is telling us visually with these series of long upper shadows that the market is having a lot of problems around that resistance level. So even before the shooting star, and the next day we had a bearish engulfing pattern, even before the shooting star, we shouldn't be surprised if the market was rejecting higher levels. One of the great things you could do with candlesticks also is not only thinking about buying opportunities, but exit, not only shorting when you get bearish signals like this, but we know shorting in equities is hard. Obviously in options it's easier, in forex it's easier, but you could use this as a signal to think about taking profits from long trades. So definitely on the shooting star, but even before that, one could think about taking some profits on long trades, or at least moving up protective stops. Okay, here we have a series of long lower shadows, and what I tried to do is give a series different time frames. Like the prior slide was daily. This is a weekly chart. And in the circled area, we could see a series of long lower shadows. Obviously, a little bit of a hint that the bears were losing momentum. over here. Oops, let me just erase that. At this doji, and we could see previous to the doji, look what was happening to the size of the black real bodies. So although in this section we're focusing on shadows, real bodies also are very important. So those increasing, those large real bodies obviously shows the bears are in charge. The doji turns the trend to more neutral, and then the market starts stabilizing, but it's stabilizing with a series of long lower shadows. So visually we're seeing it's rejecting lower levels. Now we could have a support area around 1040, but what if it was a series of black real bodies? All right, I'd be less likely to say that's a good support area if we have a series of long black real bodies. Yes, it's support, but we're not getting a visual indication that the bulls or at least the bears are losing control or the bulls are stepping in. Here we see the markets rejecting lower levels. How? By a series of long lower shadows. Let's look at another common mistake. That candlesticks, the short-term trend, really has to be part of the candlestick criteria. We understand the shape of the candlestick line, a hammer, a shooting star, a bullish or bearish engulfing pattern, bull separating lines, and so forth. But we also have to take into account the trend of the market. A hammer is not a true hammer unless it comes after a downtrend. A shooting star is not a true shooting star unless it comes after an uptrend. We actually have, I've developed candlestick recognition software called Nison Candle Scanner, and it has 14 of my favorite bullish and bearish candlestick signals. I'll give you information about it towards the end of the session. But the reason I bring that up is because it allows you to scan through all the markets. Let's see the S&P 500 and find hammers and shooting stars within seconds. And part of the way that we made the software is defining short-term trend. That's proprietary how we do that, but you're not going to see a hammer coming highlighted in this candle scanner that's coming after an uptrend. A hammer has to come after a downtrend, and shooting star after an uptrend. So here, for example, this is not a bullish engulfing pattern. It's a green wrapping around a red. Why is that not a bullish engulfing pattern? Let's look at the prior trend. And this, by the way, is a Forex market. Look at the prior trend. It is mainly up or even neutral. A bullish engulfing pattern needs to come after an immediately preceding downtrend. I got this nice email from Carl a while ago about the importance of the correct education. Okay. And this is interesting. I recently purchased a technical analysis package from a well-known technical analysis guru during a strong uptrend called the large white real body. That's this. After a small black real body, a bullish engulfing pattern. Okay, if I hadn't bought and studied your education, I would have never known that, and I would have assumed he was right and could have lost a lot of money. So again, the concept here, this is a white candle not only wrapping around one black real body, but two. And this would be very significant if it came after a downtrend. But as an uptrend, it is not a bullish engulfing pattern. So this would not be viewed as a time to consider buying. So always take into account trend of the market, very important. Okay, here is an example of, I think this might be a Forex market. And this is actually the Nison Candle Scanner. And I had it highlighted in engulfing pattern. This is what the little E is over here, a little hard to see. Plus E is a bullish engulfing pattern, plus E is a bullish engulfing pattern. So the candle scanner picked up the engulfing pattern. But the reason I wanted to show you this is notice there's no E over here. Plus E. There's a green wrapping around the red, but why didn't the software pick up this as an engulfing pattern? Again, the trend is wrong. Okay, so always take into account trend. This is a very important concept. Trading candlesticks without market context. Okay, there's something to be aware of, that is very, very difficult to actually test candlesticks in isolation. And the reason for that is because you should never trade based on a candlestick signal alone. They're part of what I call my trading triad. Triad is candlestick signals. That's one part. Triad is Latin word for three. The second part is combining candlesticks with Western technical indicators, and the third part is trade management, especially risk reward. So you can have a perfect hammer, but if that is not confirming a support area, I would be very wary about buying on the hammer itself, because we're trying to pick a bottom, right, with a hammer. We want the odds on our side. And if it's not a good risk reward, we wouldn't do the trade either. So just to give you a sense of, what's involved with learning about candlesticks, this was actually a picture of my work desk. And these are just some of the Japanese books I've had translated. Keep in mind, everything out there in candlesticks is based on my work. And I spent I spent a year going over these translations. And by the way, this book here, this binder, these are all the English. These are all the English translations of these Japanese books. So you can see how many hundreds and hundreds of pages. Each one of these pages, by the way, was like $70 to pay a translator to do. So it took me a very long time to, get these translated, then to synthesize all the information, because the Japanese do everything by analogy. So I learned about military history and Japanese culture. But the point is that the Japanese, don't only look at candlesticks to set up their trading strategy. In fact, here's one of the translated portions of a book I had done. Tagori is actually the Japanese word for hammer. So just to give you a sense of what's involved and what took me so long to really reveal these, what I call secrets of the Orient. In each of the patterns, they talked about here, for example, if this occurs during a decline, we talked about the importance of trend. What prices are low? What does it mean when prices are low? So I look at overbought, oversold, hints of a bottom, proving percentages. What do we look at to see hints of a bottom? Well, if a Western signal confirms a candlestick signal. They talk about trade management, candles in context. So if you see this candle, if you survey other conditions, this is what I mean by candles in context. And in each of the candle signals, they talk about the psychology of the market. So I've had, about 16 books translated, and it was really a challenge. It was a lot of fun also to kind of put the different books definitions of the patterns together and pick what I thought were the most salient and most important points. And by the way, I really got encouragement doing this, because when I was doing the translations back in the 1980s, I was working for a brokerage firm giving trade recommendations. And so I started to do trade recommendations based on the candlesticks. I didn't let the brokers know that, because this was still new to me. And I had the best trading record in my department. And based on that, it gave me a lot of positive reinforcement to continue spending money on the translations and going through all the work and time necessary to, as I mentioned, uncover these previously secrets of the Orient. So this gives you a sense of what's involved. It's not just recognizing the candlestick signal, but looking at everything else in context. So here, for example, we have a doji. And we have two doji, okay, but we view them completely differently. Here we have a doji in the middle of a box range. Okay, the Japanese call lateral trading environment a box range. This doji doesn't tell us anything new about the market. The market is undecided. What is this box range showing us? Imagine the market's rallying and selling off and rallying. It's confused. It doesn't know what it wants to do. I wouldn't do anything with this doji. However, let's look at this green doji. Do you think that's more indicative of the market maybe potentially stalling? And if so, why? Right, it's at a resistance area. It's now at the top end of the box range. It's now at resistance. So here's a nice example. Exactly the same candlestick signal, that is a doji, but we treat it completely different within the market context. Some doji here, and the blue arrows. Now, based on education, our education, we say normally a doji is telling us the market is tired. Why would I not be bearish in these doji? What's happening with each of these doji? Higher close, right? Higher close, a little gap there, rising window, a higher close over here. So for something like this, I would want some bearish confirmation by at least maybe a lower close under the doji's close. But keep in mind, just understanding what the candlestick line looks like, the hammer, the shooting star, the doji, is not enough to give you a reason to do a trade. It's funny, I used to do seminars up until I started to reveal these strategies to the retail self-directed trader, because up until 2000, I only did seminars for major institutions. So back then they did prop trading, and I think it was, I forget what shop it was, but the head trader wrote back to me after I did a seminar for his group. You're right about a little knowledge being a dangerous thing. We're all running around here shouting doji, doji, doji. So yeah, they get excited, they see a doji, but the trick is to know what to do with it. And once again, this is not, we have multi-day seminars on candlesticks. This is not a course to show you all the nuances of candles and how to trade with them, but I want to bring out some common mistakes to be aware of, so you understand that you have that next level of education with the candlesticks. Okay, another Japanese proverb: "He whose ranks are united in purpose will be victorious." Interestingly, these Japanese proverbs, I put one at the beginning of each of my books, and that's what the press actually picked up on. They like the proverbs, and so the press picked up on that. So the theory behind this, and I alluded to it before, having a candlestick signal is fine, but the odds of return are better if it confirms a Western signal. Example, my favorite Western signal is just support or resistance, horizontal support or resistance. And we actually call this confluence the multiplier effect. So where a Nison candle signal, and by the way, our shop calls it Nison candles because we say it's candlestick training the right way. As I mentioned before, there's a lot of education out there. Unfortunately, a lot of it is very dangerously bad. I've seen educators calling shooting stars, even though they come after a downtrend. So that's why it's called Nison candle signals. But where a candle signal confirms another indicator. And this is what's powerful about the candlesticks. Whatever your favorite Western indicators are, moving averages, trend lines, Fibonacci retracements, stochastics, you add them onto a candlestick chart, because if a candlestick signal is confirming your favorite Western indicator, and you have a lot of experience with your Western indicator, the odds of the market moving in your favor are increased very, very dramatically. And in fact, years ago, when we did an article about me in Active Trader magazine, and it was an interview, and based on the interview, they came up with the title under my name, and I'm glad they did, because it really showed they understood, meaning the interview, understood the importance of not only using candlesticks, but merging them with Western indicators. So, helping East meets West, that's what it's all about. That's the second leg of our triad. The first leg is candlesticks. The second leg is Western technicals in combination with candlesticks. So here we have a hammer and a support level. To me, that'd be much more important than having a hammer not confirming support. And as I mentioned, I like just looking at horizontal support or resistance. I look at also 20 and 50-day simple moving averages to get on a daily chart to get a longer term trend direction. I'll look at Bollinger Bands, get overbought and oversold. But as far as a simple Western indicator, I just like looking at horizontal support or resistance. Likewise here, we have a falling window. And for those of you who are new to candles or maybe don't remember what a window is, a falling window is the same as a gap in Western technicals. And a window is just a gap, as I mentioned. and the falling window is resistance. And the market could get above resistance, but as long as it doesn't close above the resistance, it's still a resistance. And that's, speaking of, closing above resistance, I mentioned how long it took me to refine the translations. It took me about a year to translate the translations because there was a lot of nuances, a lot of things that on first reading, it really took more insights. So for example, with windows, one of the Japanese books I had translated says that the market can momentarily go through the window, but that window will still be support or resistance. What does it mean momentarily, right? So I looked at hundreds of charts and I discovered that momentarily means it doesn't close above a falling window or below a rising window. So here we have a falling window. It pushed above the falling window but didn't close above it. So that falling window is still resistance. So here, the first red arrow, is market at resistance. Yes, right? I think we all agree with that. Second question is, are there any candlestick signals telling us the rally is running out of steam on that long white real body? And the answer is no. How about the next session? Right? The market is at resistance. We all agree with that. Is it stalling at resistance? It's almost a doji. Now we could say yes. So in one candlestick session, we confirm that the whole tone of the market had changed because we're getting a candlestick signal confirming a Western signal. And once again, using the candles to get a sense of the momentum. For those of you who use oscillators, I'm not a big oscillator user. No reason, it's just that I never, got involved with them. Once in a while I may look at RSI, but I like I mentioned, I'm just a clean-cut classic chart guy. Look at mainly horizontal support and resistance and some other basic indicators. But here we have some bearish divergence where the market is making new highs. So over here on the first blue arrow, we have a bearish engulfing pattern. And for those of you who are a little bit more savvy with the candles, you may recognize, 3 candle lines here. Also as an evening star. But the point is we had some bearish candlestick signals. At the same time, we had negative divergence. And we have a shooting star at the second blue arrow. It's negative divergence. And what's another reason to be bearish on the shooting star? It's a very obvious reason. Market's at a resistance area. Here we could use volume if you just want a little extra input about the force of the move. This is a classic bullish engulfing pattern. And there's a white body wrapping around the black body. Notice how there's much larger volume on the white candle than the black body. And, candles don't always work. Here's a nice hammer right over here. Now, again, I don't know if it's confirming support or not, but as soon as the market closes under the hammer, that's a broken support level. Nothing, candles are not 100%. Nothing is 100%. The Japanese say even monkeys fall from trees, right? Nothing is 100%. Get back to the arrow here. Here's a cartoon we had made up. I work with a cartoonist. I can't tell you how far it is, but I do know it's that way. And the reason I wanted to show you this cartoon is to give you another common mistake. Whoops, sorry about that. Okay, candles do not give price targets. Okay, for those of you who test candlesticks, this is a real challenge because we all have different ways of gauging a price target. Just because you get a candlestick signal, even if it confirms a Western signal, unless you have a good price target with risk reward, you don't do the trade. So if we have, say, a hammer confirming support, and my price target is $5 higher and yours is $20 higher, I might do the trade on that. I may not do the trade on that, but you have a different price target than me, you would do the trade. And just because you get a candlestick signal doesn't mean that the market's going to go in that direction the next day. I don't have that as a mistake here, but as long as I'm talking about it, I'll bring it up, I'll mention it. So you have a hammer. Some people think you have a hammer. It means the next day the next session, the market's going to rally. It does not mean that at all. It just means that that hammer should be support, and you use that hammer to see if it's a good risk reward. And we'll look at risk reward in a minute, but keep in mind, candles do not give price targets. So one of my favorite price targets is a box range. That's a lateral trading environment we discussed before. So if the market breaks out of a box range, right, we take the height of the box range and add it to the breakout area on the upside. If it breaks under the box range, we take the height of the box range and subtract it from the downside. I view this action in here kind of like a coiled spring. And once you move outside of the box range, the pressure, the tension of the spring is released and the market could get going. So here, for example, classic box range. Okay, this first blue arrow here, this is actually called the gravestone doji. Right over here. Whoops. Well, you get the point. Right over there, the first blue arrow. And it's actually a shooting star, but the opening low and close are on the low of the session. And the Japanese call it gravestone doji because it looks like the tombstone. It looks like a tombstone, and they say it represents the tombstone of the bulls who died defending their territory. So here we have a classic box range. Market broke out of it, and that gives us a minimum. That gave us a minimum target. But the point of this slide is the candles have nothing to do with the box, with the target. That all has to do with Western technicals. The candles shown on the blue arrow in the middle, the yellow arrow in the middle here, the candles do give us nice reversals. We have a bullish engulfing pattern. We have a gravestone doji. We have actually a shooting star over here. But once the market closes above the shooting star, you know, it's no longer a resistance area. Same thing here. Microsoft. Okay, I haven't looked at this market in a while. I did this a week or so ago, but this is the target on Microsoft, just taking the height of the box range from 73 to 76, add $3 to 76, and we get a target to $79. By the way, one of my favorite strategies, I think it's been a long time on this, but one of my favorite strategies is, let me see, make sure I'm not going to talk about it. Yeah, change of polarity. So we're old resistance. Once the market breaks above it, becomes a support area based on the close. See how this resistance became support? So interestingly, we had a doji over here, right? But I wouldn't be bearish on it because one, it's it's holding the highs very well, and two, it's still holding a support area. Now, a common mistake also is using candles only for reversals, picking tops and bottoms. But we also could use candles for momentum trading. In other words, trading breakouts. Let me show you an example of that. So we could use a doji as a resistance level. Most of the candlestick signals can be used as support or resistance. So we could use the doji as a resistance area. So here we have a doji and a white candle. Now the doji has a higher shadow, upper shadow, than the white candle shadow. So this becomes a resistance area. And how does it help us? Well, if the market closes above that resistance, the Japanese will say the market's refreshed. Remember, with a doji, the market is tired. But a close above the doji means the market's refreshed. And in that case, you could actually think about buying going into the direction of the breakout. So here we have a couple of doji. So we have the doji at the first red arrow confirming a resistance area. And a good reason to be potentially nervous about this is a doji confirming resistance. There's still a close. It's holding up very well compared to the prior close, but it's doji confirming resistance. But the next session is a breakout. So that is a momentum trade. You could actually think about buying it there. By the way, you can see the change of polarity. Just draw this here. This is something, the change of polarity is something I really hadn't planned on talking about. But this old resistance area, this became support based on the close. But anyway, and now let's look at the second doji. All right. Now notice this resistance area over here. The market would have to close above the high of that upper shadow green candle, because that has a higher upper shadow than the doji. And notice how it's stalled there. So once again, you could use candles for momentum. Okay, here in the S&P, this is actually a call I made back in 2013. I actually added, another, I don't want to say it's a mistake, but people don't realize you could use candles and technicals for your long-term investing. I certainly do. I use it for my retirement account, for when my kids, my kids are out of college now, but for the college fund. And so, for example, here back in 2013, I shifted my portfolio to much more on the equity side. And the reason for that is because there was a breakout above the 1500 area. And once the market broke out, I then had a target based on the box range of 2500. And this was a call I made back in 2013. And this took the height of the box range, and there's always a price that says I'm wrong. So I used a change of polarity, this prior resistance, as support. And if the market closed on a monthly basis, and again, this is my long-term account, so I don't mind waiting for close of the month. If the market closed on a monthly basis under 1500, I would say I was wrong about my projection, about my outlook, and the support area. But it held very nicely. In fact, you could see it tested around 1500 or so. The point here is the fact that the market broke above resistance area. There was a bearish engulfing pattern here. I'll show it. Let me show it over here. There was a bearish engulfing pattern here that acted as resistance. But once the market closed above it, and especially since the resistance was tested over here, we had multi-tested resistance, we had a box range, and we were then able to get a target. Let me erase this. And this was obviously a momentum trade. Okay, I had discussed the trading triad. We're going to quickly now look at the third leg of the triad, trade management. And with that, I'm going to have a little trick to show you. Okay, everybody see these cards? Okay, I want you to pick mentally one card. Everybody got the card? Okay, the next slide, I'm going to show you this slide. Okay. Magic, your card is missing. My goodness, how did he do that? Well, the reason it works, and I'm sure some of you know this, is because on this slide, every card is different than this slide. So of course your card is not on here. But the reason it worked for me, the first time I saw this, is because we're just focused on one card. Right? We're not looking at all the cards. And that's the point with this concept of a common mistake. We will look at candlestick signals, maybe confirming a Western signal, but we always have to take into account risk reward. Critical. So I have about 15 what I call Nison trading principles, derived over my 35 years of research and trading. Risk reward. A candle signal, even if it confirms other indicators, is not enough of a reason for a trade or an investment. You must always consider risk reward. Okay, which is better, a better bearish trading signal, whether a reason to exit a long or do maybe a bear trade. By the way, candles are great for options, for timing, especially on bear trades, because if you get a good bear trade with options, obviously in many instances implied volatility will pick up faster than it would be with a bull trade. Which is a better signal, the bearish engulfing pattern or the shooting star? Well, the bearish engulfing pattern is a large black real body wrapping around a white real body, and the shooting star is a single candlestick line. It's not really showing us the bears are taking over from the bulls, but that's secondary. What is important is candles in context. Now I'm going to show you these two patterns again. Okay. This is a classic bearish engulfing pattern. Why? Look at the size of that black real body. Here we have the shooting star, the green arrow. Now let me ask you, which would be a better trade from the bear side, the bearish engulfing pattern or the shooting star? Once again, a target is subjective. I would just be looking at the blue line at the recent lows. You may be looking at something completely different. But based on my perspective, my subjective view of the target, the bearish engulfing pattern is not a good trade. You'd be actually risking more, because you're risking to the high of the bearish engulfing pattern on a bear trade, than profit potential. Whereas the shooting star, which is also almost a gravestone doji, much, much better profit potential, right? Lower risk, you're risking $1 to potentially make, looks like $3 or $4. So once again, you could have a great, all right, Sean wants to know about the candle scanner as a package. Yeah, Sean, thank you for asking. I will mention that at the last slide. So here we have the shooting star as a better trade, potential trade, because of risk reward. And also it's confirming the recent highs. Okay, here we have a classic hammer at a support level, right? Lows at support. So we have two of the three things. We have a candlestick signal, and a hammer could be black or white real body. We have a confirming a Western signal. What's the third aspect we need to take into account? The risk reward. So let's think about this. My target would be the falling window, which was confirmed as resistance with the doji. So would you do this trade? Would you be buying at 76.5, risking $1 to make less than $1? Probably not. So I'd be standing away from this trade. Always look at the risk reward. And that's part of the idea of candles in context. Candles in context of Western indicators and candles in context of risk reward. You have an interesting one. One of the patterns that I see on the internet, that not from us, that is like their favorite candlestick signal. This is really called the bull separating line. The other educators may call it something else, and they talk about what a great signal it is. The problem with this is that by the time you get the signal, the later it is in the trade, because you have to wait for the close of the white candle. So let's look at this. Here we have a bull separating line. Look at the time you get the signal. It's right near resistance. Would you do a trade with this supposedly super pattern? Obviously not. Sean wants to know about candle pattern failure. Or sorry, Sean. Sean just relaying the questions from the viewers. Thank you for the questions, and thanks for relaying them, Shane. I'm sorry, I keep on calling you Sean. Sorry, Shane. Is there any concept of candle pattern failure? Yeah, the candlesticks can be used as support or resistance. So in other words, here, for example, here's a shooting star. You could use that as a resistance area. If the market closes above it, the shooting star has failed at resistance. Shane also is relaying, does the size of the bearish engulfing pattern determine how difficult it is to break through? Yes. If you have something like this, a long black real body, this is showing you the bears aggressively stepped in And this should be very strong resistance. And indeed, look what happened. If we had a small black real body wrapping around a small white real body, that to me would not be as solid resistance as something like this would be. Okay, we'll wrap it up in a couple of minutes. All right, so here's a question we got from one of our students, and he said why he went long. So let me go through this here. There was a bullish engulfing pattern. You see the green wrapping around the red. It was at a support area. It also broke above a falling resistance line over here, the yellow line. And look what happened. The market sold off after. So his question is, was that a good trade that just didn't work out, or did I make a mistake in judgment that I can't see? And what do you think his mistake in judgment would be? What is the section we're talking about now? The reason I showed you the two-sided red and yellow arrows. What was wrong? He had the correct candlestick signal, green wrapping around the red after a downtrend, confirming support. But what was the third leg of the triad? Risk reward. Right. It was not a good risk reward. By buying this bullish engulfing pattern, he's actually risking, that's the yellow two-sided arrow, more than the profit potential. So I would not have done this trade. Okay. So he was right about the candle. He was right about the Western technicals. He forgot about the third leg. And this is a nice one to kind of wrap it up for a final slide or two. Here we have the master carpenter and the poor guy with his thumb and the master saying you must learn to use the tools properly. So we started to look at some of the mistakes so you can use the tools of the candlesticks correctly, and let's bring it stuff together with this last slide, and then I'll show you how you could invest in our Nison candle scanning software. So here we have a doji, a bearish engulfing pattern over here, an evening star. Now in this green candle, it says close over resistance. Does that mean you buy it? It's a breakout, right? All right, so here it broke out, but look at where resistance is. So if you're buying that on that green candle, you're buying at resistance. So that is not a good trade. Okay, now the evening star is followed by 3 black crows. So let's look at this. 1, 2, 3. 3 black crows and 3 black real bodies. Let me ask you, would that be a trade signal? And again, think about this. From a risk-reward perspective, would that be a good trade signal? If you sell it there, what's your target and what's your stop-out level? And the answer is no, it would not be. Because if you sell it here, at least my support, yours might be somewhere different. My support would be down here, and my stop-out level would be here. So it'd be a 1-to-1 reward risk. That is a trade I would not do. Okay, now here we have a hammer. What bullish candlestick signal is this? Based on this hammer, would you buy, why, or why not? And the answer is 2 reasons. 1, okay, it's closed under a support level. And 2, at least based on here, the hammer is not confirming a support area. The main point is we have a hammer, classic hammer, but it's under a support level. So what I would be doing, I'd be waiting for this hammer for bullish confirmation is a wait. Remember that change of polarity, old support becomes resistance, or old resistance becomes support. I'd wait for close above the change of polarity above this second blue arrow. So we're getting a lot of questions about NCS. So let me give you the link over here. We have 2 options with NCS, and we've also, due to my relationship to the MTA, we're also giving you a special code, NCS 400. So go to this link here, www.candlecharts.com/NCS. You could read about all the things NCS does. It does scanning. It'll let you scan through any markets in any time frame. You can pull up any chart. It'll pull up all my favorite candlestick signals for you intraday traders. It will alert you real time if there's like, say, a 10-minute candlestick hammer in Google or whatever. So go to this link here to give you information about NCS. Again, we have this as either monthly or lifetime. So thank you so much. I'm going to wrap it up now. And it's always a pleasure doing work for the MTA. And really the thing that really sparked me into the candlesticks was a couple of pamphlets I found in the MTA library back in the 1980s. So the MTA has been vital to my education with candlesticks. I worked very closely with the Nippon Technical Analysts Association back in the 80s, early 90s, as part of the worldwide organization of technical analysts. So the MTA has been a real asset, and my pleasure doing this session for you. Okay, thanks, and have a great day.
And on behalf of the CMT Association, I'd just like to extend our sincerest gratitude to you, Steve, for sharing with us this terrific presentation. Your time and expertise are greatly appreciated. For our audience, I do encourage you to head on over to candlecharts.com/NCS using the coupon code NCS400 if you'd like to take advantage of this limited time offer. For those interested, a copy of today's presentation will be made available in the CMT Association video archives over at cmtassociation.org a little later this evening. If you do have any additional questions we could not get to today or that you think of while watching the archive later on, please feel free to send them over to me or any member of the CMT Association staff, and we will gladly pass them along on your behalf. That will wrap up today's Educational Web Series webcast. For the CMT Association, my name is Shane Squarick. I thank each of you for spending the hour with us and look forward to seeing you again next week. So long, everybody.